Hello and welcome back to the channel. In the last edition, we did review GIC Ray, which was into insurance sector, primarily into reinsurance sector, and how we saw that the stock had significant potential of being undervalued. The stock was trading at a market cap of close to 70,000 crore, but had a asset under management of uh, 94,000 crore. It was generating an investment income of 11,000 crore, and it had cash on book of 25,000 crore with a PE multiple of close to 9, with a dividend yield of 2.5%. So we did see that the business and how it had degrown, and how from 50,000 crore a couple of years back, on which they were generating a loss of close to 250 crore, they turned around the business and they were prudent in the underwriting and the risk selection that they were doing, and because of which they were able to turn it around from they degrew. They went from 50,000 to 37,000 crore. On that 37,000 crore, they were able to generate a profit of close to 6,000, 6,500 crore. So they did that, and they did all of those things. And insurance has been in the news lately. It has been in the news because of the new proposals of limiting bank assurance to 50%. So bank assurance is nothing but the banking channel, and a lot of the life insurance companies like HDFC and SBI, they have an advantage over some of the smaller incumbents who do not have such a vast banker channel. But really, they wanted to limit the banker channel to avoid mis-selling. That was the primary purpose, because through the banker channels, a lot of mis-selling was happening in terms of people being sold ULIPs and people being sold guaranteed plans with minimal returns, and not the right fit for the right people, kind of thing. In this edition, we'll be looking at ICICI Lombard. We'll be looking at what the valuations are, where does the market cap stand, what are some of the things that is doing, what are the numbers that they're doing, what is the portfolio mix, what is the TAM globally, what is happening in terms of where the global insurance penetration is compared to India, and where does this company go from here. So we'll be looking at those things. In the first slide, we'll dive right in. And in the first slide, we can see that there are the pillars of strength, which is listed in the half year 2025 presentation of ICICI Lombard. And what they are basically saying is that they are a leading private sector non-life insurer in India since FY 2004 GDPI basis. GDPI is the premium without the inward reinsurance. So it's the pure premium that the business has written, and we can see that 16 years the CAG, so 16 years GDPI CAGR from 2008 to 2024 has been for ICICI Lombard 13.4%. So they have grown at a good clip. And even at the larger base, they are able to grow at a much faster rate. And they have had a good growth, and they have been listed since 2016 or 17. We'll check that when we go into the price chart later on. And we can see that their market share as of H1 2025 is close to 9.4%. So obviously they are the leading private sector non-life insurer, and they have a market share of close to 10%, which goes on to show that how fragmented the market is in terms of how many players are there in competing against each other. And because of which pricing then becomes really important. Pricing in terms of really attracting customers, because India is a very price sensitive country, and a lot of times the details get overlooked in terms of which is a better company in terms of claim settlement and those kind of things. Anyone who wishes to take insurance, they will look at the price first. So these are some of the things in terms of its leadership. They have a comprehensive and diverse product portfolio. We'll be discussing the product mix in one of the later slides. They have close to 133,000 individual agents, and they are enhancing the penetration in tier 3 and tier 4 cities. So the kind of business that ICICI Lombard does, anything under the sun which can be insured, is insured by ICICI Lombard. So they don't do life insurance business, but they do have a health insurance arm, and they also do have crop and motor being one of the largest areas that they write business in. Um, and and what they're really doing is they're also combining artificial intelligence, machine learning, and IoT. Uh, initially, the Fairfax had an investment in ICICI Lombard. So Fairfax is a Canadian company owned by Prem Watsa, who's also known as the Warren Buffett of Canada, and who also has a majority stake in the Bangalore airport. So he also increased his stake recently. So he was into this business, and later on, when Digit Insurance did come into the picture, he sold off his holdings because um, no two investor can hold a significant holding in two businesses separately, two in general insurance businesses separately. So they decided to exit from ICICI Lombard and get invested into Digit Insurance. But ICICI Lombard has gone on to also acquire Bharti AXA General Insurance. And we'll look at those timelines in a more detailed fashion in the later slides. So in terms of risk management, they are growing. They have what they say is they have a profitable growth. They are using risk selection and data analytics. They have a robust actuarial function. They maintain robust reserves. They are one of the few companies who have been um, mentioning their reserving triangles into the public disclosures. And what they also say is that a prudent investment management. So most of the investments that they have will be in bonds. 88% would be in bonds, and close to 12% is in the equity market. On a weighted average basis, they are generating close to 7.98% return on their investments. Um, yeah. In terms of the solvency ratio, now, what do we mean by solvency ratio? Solvency ratio is nothing but the available solvency margin divided by the required solvency margin. In a way, this is used to gauge whether the insurer is able to pay off its long-term liabilities or to meet its liabilities in the short term, mostly in the general insurance field. And the minimum requirement set by the regulator IRDA is 1.5, which is 150%. And the solvency ratio that came in for ICICI Lombard was at 265% as at September 30, 2024. So these are some of the things which investors or the analysts who are analyzing the stock do look at. We'll also look at some of the other things that they are looking at. So now here, when we see the key highlights in terms of the business written, so this gross written premium will include reinsurance inward premium. So what you can see is the gap. The gap is nothing but this number is the pure premium that they're writing, except for the reinsurance inward premium. Um, and here these numbers are represented in billions. So if you multiply it by 100, we'll get in crores. So here it's nothing but in FY 2023, they wrote 21,000 crore worth of business. And in FY 2024, they wrote a 24,776 crore worth of business. So here they're growing in terms of GDPI, they're growing at a rate of close to 17 to 17.8 to 18%. And a combined operating ratio. They have a combined operating ratio of 104.5, 103.3%. Combined operating ratio is nothing but when the incurred losses are combined with the expenses, the underwriting expenses, and divided by the earned premium. That would be the combined operating ratio. And what they're also mentioning that the combined operating ratio here is excluding cat losses. So cat losses is nothing but catastrophic losses or the large losses to the tune of 94 crore in half year of 2025. So there were some cat events because of which 94 crore was Lombard was impacted by 94 crores, and this would be on the gross basis. They would also have some reinsurance to take care of these cat losses, and but these are not represented in the calculation of the combined ratio. So in terms of profit after tax, they're generating a profit after tax of close to 19 crore on a business of 24,776 crore. And a lot of it, because the combined operating ratio is already higher than 100. So this would depend on the investment income that they're generating. And in terms of the income that they're generating, is causing it to be a positive profit after tax. So here we see the profit after tax for half year of 2024 was at 968 crore, and here it's 1274 crore. And the full year FY 2024 was sitting at 1919 crore. And the solvency ratio has consistently been higher than 2.5, which is 250%. And although the regulator has a target of 150%, but companies, general insurance companies within their internal targets have a ratio which is much higher than the regulatory requirement. Usually would be in the range of 1.7 to 1.8, but all the general insurance companies would have their own internal rate of return, own solvency ratio, internal targets, depending on the risk appetite and the risk that they're writing, and the risk threshold that they have within their risk management committee. So here we can also see that from FY23 to FY24, the basic earning per share has also risen from 35.21 to 39.03. Here we look at the comprehensive product portfolio. Now the product portfolio is divided into motor OD, motor TP. So if you combine the motor business, the motor OD and motor TP business, that forms the biggest chunk. That formed 39% in FY of 2024 and 41% in FY of 2023. So what we see a degrowth by 2% in the motor business from 2023 compared to 2024. And we see a rise in health business from 27% to 29%. Um, Fire business has remained stagnant, 15 to 14%, and marine 3%. Crop insurance is close to 4%, and others would be also stagnant. So the big shift I think that we've seen is in the health, where it's moved up, and in the motor it's moved down by 2%. But yeah, these fluctuations can be driven by strategic thoughts, but it can also be driven by cyclicality and the business, the way the business is working. So obviously after COVID, a lot of people have become aware of about the importance of health insurance, and that also would contribute to the rising share of health insurance within the product mix of ICICI Lombard. So here we see the comprehensive product portfolio of motor. So so in terms of the motor GDPI mix, private car, two-wheeler and commercial vehicle, we see that private cars holds the highest segment, 50 close to 50%. Two-wheeler is 25%, and commercial vehicle is 21.6 and 21.8%. There was a change in close to I think 2018, where earlier what used to happen was the insurance used to be whenever you would buy a new car, it would be written for 1 year. But the regulator did come up with something like a 3-year policy. So earlier it was that you could take 3-year OD and 1-year TP, but it came out with long term. So you can buy 3-year policies all together, and because of which there has been a growth in terms of how, because what would happen is people would buy cars and they would forget to renew their insurance, and that would put them under a lot of risk because motor TP is mandatory in India. And the regulator did come up with this, then um, the insurance that they did buy at the upfront would sustain them for 3 years. So that would have increased the volume numbers for the motor insurance. So 72.8% of agency and direct claim service through PPN. So that is something that they have. And here, if we see the loss ratio, so in terms of the loss ratio, we see that in FY 2023, they had a loss ratio of 72.4%. And in FY 2024, they have a loss ratio of 65.2%. Now, all this will really depend on the risk selection that you make. So for example, if ICICI Lombard is able to get the business of school buses are considered a good risk to ride because they move from point A to point B, and then for the whole day they are waiting for the kids to come back and jump onto the school buses. So the loss ratios would be lower for school buses, and something like a if you would write insurance for a company like Porter, which are Tata Ace, again point A to point B regulated, and they have monitoring from the startup that they are, and they would have speed limit on their Tata Aces. So if those businesses do increase within the portfolio, then the loss ratios would be tending towards downwards. But there's a huge fight for those businesses within the sector. So the companies which are able to write those businesses would end up with a lower loss ratio, both in terms of motor OD and motor TP, and that should do the case uh, a lot of good in terms of maintaining a positive loss ratio. So here we see that they wrote close to 4,894 crore worth of TP-GDPI, and TP-GDPI is higher than the OD-GDPI. OD-GDPI, they wrote close to 4,740 crore, and in FY 2023 it was 4431. So these numbers are represented in billions. So if you multiply it by 100, you will get it into crores. So 4,431 crore for FY 2023, and 4,151 crore um, for 4431 for TPGDPI, and 4151 for ODGDPI for FY 2023. So here we see the health, travel, and PA GDPI mix. Even in health, travel, and PA, we see that individual is contributing close to 16%. Group others is contributing 28 to 24.7, and group employer employee is contributing close to 55.3% to 57.5%. This group employer employee usually is the one where, and group others. So group policies are generally the ones which are on the higher loss ratio. Um, but ICICI Lombard is able to maintain a loss ratio which is lower than 100% without expenses. So 70, close to 77.3, 78.9, and 80.6 and 83.2. And it's been in the range of 79% in FY 2023, and FY 2024 around 78.9%. But it has risen. It has risen in the half year. It has risen to 83.2% in H1 of 2025. So health insurance, really, the first year that you do write it, it comes with its pre-existing diseases. So they will, the first year that you do write it, it comes with its waiting period. Once you do hit that waiting period, so till the time the waiting period is hit, the loss ratios will be lower. And as soon as you hit the waiting period, the loss ratios tend to go higher. That is a general trend that there is. But now health insurance companies have also become very smart in terms of trying to evaluate the claims that they can reject. They would try and see what are some of the disclosures that has not been made by the policyholder, and try and reject as many claims as they can, because of which they can maintain a loss ratio which is to their liking. But yeah, health insurance is one of the most unpopular product in the policyholders, because policyholders have a bunch of claims that get rejected, because there's a lot of fine print within the policy that there is. If you're getting a heart surgery done, then there is some report sometime in 2018 where you hadn't disclosed something, and if the claim people do come to know about it, or the people who are registering the claim do come to know about it, they can reject it on the basis of non-disclosure, and then that claim gets directly rejected. So health insurance also, the business as such, will continue to grow, because as we know that India is a young country in terms of the median age being, most of the population's median age being less than 30. So a lot of people entering into the workforce, and medical inflation is separate from the inflation that is there on the consumer CPI index. So medical inflation would be anywhere in the range of, in the high 10 to between 10 to 15%, and it would fluctuate between that. So also the hospitals are now cognizant of the fact that a patient which is coming in is backed by health insurance. So hence that also drives the health costs higher. Um, so here we see the comprehensive product portfolio of PNC. So the sum of the PNC being the property and casualty. Here we see fire, engineering, marine cargo, and liability. Uh, so so we see that all of them have been pretty much stable, except marine cargo, which has gone higher from 19.5 to 21.5%. Property and casualty, the loss ratios, if you see here, have remained in the range of 59, so 59.7% for FY 2023, and it's been higher. FY 2024 has been in the range of 68.6%. Um, so it's gone higher by almost 10%. And they are writing a business of close to 5,973 crore in FY 23, whereas it has increased to 6,851 crore in FY 2024. And in the half year of 2025 as well, it's in the range of 68%, which is in line with FY 2024. So crop is also something that ICICI Lombard writes. Crop contributes, as we saw, close to 3 to 4% of their total GDPI, and these are some of so they have a conservative reserving policy. That means that they reserve for more than what they anticipate, and then back it up and keep it aside to meet future obligations, future payout obligations. So here we see that crop insurance they're writing in the range of 1,175 crore in FY 2024, and the loss ratio was 88.4%, and in FY 2023 80.1% loss ratio. And these would all depend on where you're writing a crop insurance, whether you're writing close to the coast, eastern coast, obviously are very susceptible to cyclones, and because of which, if the cyclones do hit, then there may be a lot of payout that needs to be made. But the claim assessment right now is also very not that advanced. It is done on a sample basis, and there is a lot of chances of it not being appropriately paid out. So it may be the case that the sample that is selected is much better than the population of the crop insurance that needs to be paid out, and hence the payout can be lower. So all those things are there. There are drawbacks, and I'm sure I think the government would be thinking of deploying AI and drones and those kind of things to enable proper claim assessment for crop insurance. So here we see in terms of the risk management, what they are doing. So this risk management divided into four quadrants. Reinsurance is a big part. Now reinsurance is so ICICI Lombard has a net retention of close to 70%. Now what do we mean by net retention is that if we are writing 100 rupees worth of premium, then it is ceding 30 rupees to reinsurers, and it is a strategic move in terms of enabling stability in the profitability. They want to cede the risks which they feel are high probability of losses, or portfolios which have a threshold, which have a loss threshold larger than what it can carry. So hence it goes out and cedes it. So for ceding it, it needs to pay reinsurance companies premium, and then accordingly any cat event that does come in, then they are protected on the basis of the reinsurance that they write. So there are various types of reinsurance that they write, and so we had discussed GIC Ray in my last assessment, and I'll be attaching the link to GIC Ray here as well, so we can go and check that out. So in terms of underwriting, they're using predictive ultimate loss model to improve risk selection. They have diversified their exposure across geographies and products. And historically, they have a lower proportion of losses from catastrophic events than overall market share. In terms of the investments that they have a high proportion of debt portfolio in sovereign or AAA rated securities. That is 88.5% of the investment portfolio. All the debt securities are rated AA and above, and zero instance of default on the ICICI Lombard debt portfolio. That they mean to say that in the ILFS fiasco that did occur, they were not so they were not involved, and they did not have to write off that asset. So yeah, that is on the investment part. On the reserving part, their IBNR utilization is improving. IBNR is nothing but the incurred but not reported. So those are the claims that are set aside to meet future claim liabilities. And uh, so what they're saying is the reserve that they're set out is robust, and they have done a lot of disclosure in terms of reserving triangles, basically, which means to say that if they had kept 100 rupees on expected claims, whether those 100 rupees went on to increase or decrease over the period for the same accident year. Uh, and hence, what they believe is that their levels are sufficient to meet all future liabilities, and they have also put it into the investor presentation, which we'll have a look at in the later section. So in terms of the financial performance, what we see is that the core pretty much is higher than 100%, 104.5 and 103.3. And then they have also made a disclosure that it doesn't include the 94 crore worth of H1 2025 cat claims that did come, which was 84 crore 84 crore in H1 of 2024, and hence these are without those cat claims. In H1 of 2025, they've had 103.2% combined operating ratio. So here we see the profit before tax. So the profit before tax has grown by 21% from FY 2023 to FY 2024. So they were doing a profit before tax, sorry, of 2,113 crore, and which is now at 2,555 crore. And the profit after tax has grown by almost 11% from 17,729 crore to 1,919 crore. So this is on the investment performance. So what we see is that they had a realized return of 7.5% in FY of 2023, and as at FY of 2024, they had a realized return of 7.98%. Given that 88% of the portfolio is in bonds, so the weighted average impact of equity, which is contributing 12%, is lower, but that is the reason why it's being pushed up by a percentage point, because the GSEC rates are usually in the range of 7%, but the realized return is in the range of 7.98%. So in terms of the investment book that they have a 49,000 crore worth of investment book. So these investment books, so they have an investment book of 49,000 crore, whereas the market cap of the company is close to 70,000 crore. And they had an investment book of 43,180 crore in FY of 2023. So in terms of the mix of the investment book that they have, 40% of their debt book is in GSEC, 43.2% in corporate bonds, and 12.2% is in equity. 12.2% is in equity, including equity ETF. They have an unrealized gain of 2,505 crore as on September 30, 2024. And the unrealized gain in equity portfolio is at 1664 crore, whereas in the other than equity portfolio, it's at 841 crore. So we'll skip the ESG part for now. We'll just look at the industry overview. So here we can see the TAM, the non-life insurance market TAM. So this is the world opportunity in terms of so the world is standing at close to 4,297. So 4,29,718 crore worth of US dollar worth of premium, which within India is sitting at close to 3,577 US dollar worth of premium within India, and emerging Asia is close to 400.11. So beyond Asia and India, there's a lot of insurance premium that there is, and we are writing a fraction of what is there available out there in the world. So here, what we can see is the significant underpenetration. This is nothing but the premium as a percentage of GDP, and that multiple for us is at 1, whereas for China is at 1.8. We have a per capita income of close to 2,800 US dollar per person per annum, and for China it is at 1.8, but their per capita income is at close to 12,000 US dollars, and USA is close to 60,000 US dollar plus, and they have a percentage premium as a percentage GDP of 9.3%, followed by South Korea at 6% and UK 2.6%. These are considered some of the more developed markets in terms of the insurance penetration. And here we see the premium per capita. So India is lagging behind in terms of just 25 US dollar per capita of premium, whereas in USA 7,504. So is the per capita premium per capita. For the UK, for the 66 million population that they have, their average is close to 1294 crore. So this is the growth of the general insurance industry as we see it. The industry CAGR has been in the range of 12.8%, and from 2001 to 2008, ICICI Lombard CAGR was at 73.3%, and from 2003 to 2003 onwards, the CAGR growth has been in the range of 17.8%. Yeah, so I think we are done with this part, the investor presentation part. We'll quickly jump into the numbers as well. So here we can see that the market cap for ICICI Lombard is sitting at close to 95,000 crore, and we had discussed that the investment book is sitting at close to 45,000 crore. The stock is trading at a price to earnings multiple of 43, book value is 275, whereas the current running price is 1933. Dividend yield is close to 0.31%. They're generating a profit after tax of close to 2,225 crore. And yeah, so enterprise value is close to 95,576 crore. Cash equivalent, they have 107 crore within the cash equivalents. So here we see the price action in terms of, so it did go into IPO in September of 2017 at a price of 680 rupees, and currently is trading at 1900, the price of 1900. So that's it from my side on this edition. Thank you. Thank you so much.